Hello, everyone. My name's Shelly Smee, and I am the host of Real Estate and Finance Fridays on the Pursuit 365 podcast. Today, we're going to speak with mortgage specialist and finance wizard Rima Zino from the DLC Mortgage Group. I believe it's DLC Valley. Are you out in the Valley, Rima?
Yes, correct. My office is in Langley. Nice to seeing everyone, and very much appreciate Shelly for the opportunity to share a little bit of the knowledge and help at least one person that make it easy on them.
Well, you've already helped a few of my clients, and I have to say, I really love the way that your approach is hands on. And today we're going to explore the documents that people need if they start thinking about applying for a mortgage. And certainly at this time of the year is a great time to get this process underway because you're getting all your tax return stuff together anyway for taxes. So why don't we start with how people should get themselves organized to get an application in to their mortgage broker, which hopefully will be you.
Thank you so much. Yeah, so the process is could be very smooth and easy for closing. That's what I'm trying to definitely make it clear understanding and set the budget and the rules and the goals up front. And everything is happening on our first discovery call when we defining those budgets, defining the goals, the short-term goals and the long-term goals, and really understand the timeline for the client. So for example, if the client pretty much ready to go, within discovery call, it's very targeted and very defined process. We just going over a little bit of information with no documents yet. First of all, to understand the big picture, the budget, the expectations that the clients have, and many of the times they have expectation. For example, they want a property of 800,000, but it's very easily to define with the very quick formula if they actually qualify for this amount, or if they even in the zone for their comfort zone for monthly payments all in. And when we're talking all in, it's not only the mortgage, it's also the property tax, the strata fee if a person buying a condo or the townhouse, and a property transfer tax if they first time home buyers or not. So definitely the very first draft kind of understanding, that's what I provide in our first discovery call. Many of the clients, they amazingly prepared for that because they do lots of research before that. So after the first stage, I'm usually providing them a list of documents and the application, what needs to happen. And for our next meeting, once all the documents in, I'm ready to prepare for them the budget, the estimated budget, just to give them a quick idea what that can look like, based the most important based on their comfort zone for monthly payment and the down payment that they have. And but the very clear list definitely they will have upfront, as well as the guide for the buyers, especially if it's a first time home buyers. It's very important to have like at least 20 pages of the guide, just to a little bit make a research for them and make the process very smooth.
That is a great overview, Rima, of your process and how you approach working with your clients. Once they understand how the process is going to unfold, what are the documents that they need to have in order to, I would imagine they're going to upload them to you or email them to you. What does that look like as far as what they need to prepare themselves?
Yeah, so the process for the documents is very streamlined already. They're usually uploading them to the secured portal, and if the clients are full-time employees, it's very straightforward. They basically need only two last pay stubs, a letter of employment within 30 days of the application, and say their down payment, of course, just to finalize that. Usually it's required 3 months bank statement to confirm the down payment. Many first-time home buyers or move-up buyers, they also first-time home buyers in particular, they're using RRSP funds. So definitely we will be required also the RRSP information. It depends in what location. The most important, definitely, not to try to move around the money before deciding to purchase a property.
So the documents, what I'm hearing you say is the documents they should have on hand is their pay stubs. They should have a confirmation or letter of employment letter from their employer. I didn't hear you say tax returns for the last 2 years. I always thought that was pretty much the notice of assessment was a requirement. Is that still a requirement, or is that later in the process?
It is later in the process. If the full-time employee, usually it's only T4s are for the last 2 years, the T4s only that they're receiving from their employment. For notice of assessment and tax returns, in particular, when it's a self-employed, contractors, commissions work, then the notice of assessment and tax return is coming to play. And also if any of the clients holding already a real estate investment property.
Right. So there is a quite different stream of application that happens between a regularly employed person that works at a firm and receives a salary than someone who is like realtors and accountants and entrepreneurs, an entrepreneur who has their own business. Why is that?
The reason being, it's potentially some lenders may require the notice of assessment for employees as well. But the idea would be if someone is actually owning taxes, and obvious for self-employed clients, because they themselves need to pay the taxes, so that's it's not validated anywhere, compared to employees when they actually already taxes deducted at the time of the paychecks from the employment as well.
Right. So I think what I can infer from what you've said is the level of debt, whether it's you still owe the government money from your taxes or whether you're carrying a lot of loan payments, say you have a new car or you're carrying a lot of credit card debt. Do you work with people to help them identify a plan if they're obviously when you speak to them about their financial situation, they have some little messes maybe they need to clear up, or they're what I used to call it in my first time homebuyer program was checking the pulse of your financial fitness. And I speak to many people where they're like, oh, I'm never going to be able to buy a place. I've got a student loan. I've got this. I've got that. I'm blah, blah, blah. I just, they feel so lost in the fact that they don't think they can get out from under their financial obligations. Do you find you can help consult with people on how to get them in a better position to apply for a mortgage? And it's not just going to be like a quick deal. Like this could be a year plan or it could be a 2-year plan. How do you consult with people who feel like they're never going to be able to actually afford it?
Yeah, so this is amazing questions, and basically that's everything. It starts with the plan, and that's why we have that first discovery call. Even if just to define those financial goals, if the client, and also really to check that pulse, as you mentioned, that we want to see the exact situation so we can plan ahead for our next follow-up meeting. And the idea would be definitely if the client needs a help how to save for down payment. If, for example, client have maybe a consumer proposal or a consumer proposal that also takes another plan, which we also depends on the down payments and other aspects of the financial situation, but definitely the plan that would be number one priority, and that's what we define in our first discovery call, to put the plan together, because no clients similar to the next one, and in most likely if the clients fit to the bank solution, so everyone can go to the bank and take a mortgage. But what I find in the recent years, you definitely have to be have solutions with outside of the box thinking and creativity in order to help the clients. And in particular in mortgage brokering world, we do have many options for clients with consumer proposal, with um, with tax issue, or any other options that definitely require that creative solution.
What is a consumer proposal? I don't know if I am familiar with that term.
So consumer proposal, it's very similar to bankruptcy, but that's in the eyes of the banking system. A consumer proposal, it's more like debt consolidation process. It's that it's set out with the different institution, and definitely it's in the eyes of the banking system. It's very similar to bankruptcy. In when you have a consumer proposal, you still can get a mortgage after you discharge, day after you discharged. With
Okay, so what does it actually do? Would that be like if I had too much credit card debt, or if I had a whole bunch of different debts all over the place, can
yeah,
you
so
end up paying less than what you actually owe?
yes, it actually can be worked through the specific office in order to consolidate that debt and to put a plan together how to do it. It is very similar to bankruptcy. Yeah.
Right, but once you've declared bankruptcy, you're probably not going to get a mortgage for a while.
For a minimum, it's 7 years, but
Wow.
yes, but we do have alternative lenders that definitely can help out. And if you discharge from bankruptcy, the next day, actually, you can get a mortgage with alternative lenders.
Right. When you say an alternative lender, does that usually come with a higher interest rate? And when you say alternative lender, we're just talking a private lending as opposed to, say, a chartered bank?
So there is actually 3 tiers of lending. So tier A, it's for grade A clients. We call it triple A clients. So those getting top interest rate, the best interest rate, with alternative lenders, because they give so much flexibility for the clients. They do have slightly higher interest rate than the regular bank, and they also charge 1% lender fee. But you also have to be in some sort of guidelines to have a good income in order to get qualified. If the client is actually self-employed, we also can use his business income, and this is regardless if they have bankruptcy or not. Alternative lenders very much working very well with the self-employed clients, because they declaring very little income compared to the mortgage they can be qualified for. So that's kind
Right.
of a side note. And the tier 3 is a private lending. Private lending, at this point, they very they're very flexible with their requirements, but at the same time, they're not requesting a lot of documents, just to make sure if all taxes kind of up to date, or otherwise the taxes will be paid at the time of the closing from the proceed of the or from the proceeds, and there is no lot of requirements from the private lending. Yes, the interest rate slightly higher.
Right. Okay. I think I understand that. So, what I'm hearing you say is, even if somebody thinks their financial situation isn't going to be right for getting a mortgage, there's often things that can be done as a plan, as a long-term plan, not like an instant tomorrow plan, but as a longer-term plan to get people in the mindset of consolidating their debt and hopefully getting in a position to qualify for some type of lending.
Yes.
That kind of brings me to another point, though. These days, we have one of the largest transfers of wealth between generations beginning to come into our marketplace. One, because it is so expensive to buy property in British Columbia and in Vancouver, the Lower Mainland in general. And another, because many of the baby boomers and Gen X people who were able to be and get into the market 20 years ago, sometimes even only 10 years ago, have a lot of equity in their property. How do you guide families to help them to use the equity in their existing properties to either assist other members of the family to purchase or have a down payment? And what are some of the things that parents should be aware of if they want to help their children buy property or take equity out to buy another property?
Yeah, so this is very common right now, especially because to help first-time home buyers unfortunately, without help of the parents, they pretty much stuck on the budget. So again, with through our strategy call, and once I understand all the resources and potential options for the client, I'm putting together a very comprehensive purchase budget and helping really to understand to the dollar what to expect. And it's not only if the parents will give the gift for the kids to buy that for the down payment, it's also kids needs to be aware how much they actually can afford monthly. So that's also coming to play with how they evaluating their finances, but definitely the help from the parents. And in particular, if there is, especially even if we're talking about the grandmas, helping their grandkids to purchase, because the grandmas usually grandparents, they don't have per se any mortgages associated, but they definitely can use their equity for as a reserve mortgage, for example, which they not require any payments for the grandparents to gift, but they can use their equity and give that funds to the grandkids to buy that first property. So
Wow.
definitely, once we define all the resources that available for these couples, we can make a strategy how to move forward.
That's really interesting. One of the things that I've come to see in my practice, though, especially in the last few years, is that there are some definite requirements for the paperwork and for the lender for this transfer of money. I believe it's called a gift letter. Can you speak to what that is and why it's so important?
Yeah, so the gift letter is one of the items that needs to be signed by the gifters, and the gift letter is usually come from whatever bank we're deciding to approach, and it's need to define that those funds are not repayables. That's kind of the main factor of that gift letter.
So it basically is a agreement between the parties that it's not like a secret second mortgage or something like that, that it's a gift.
100%. And usually the gifts acceptable by the financial institutions is from immediate family members, like a mom, a mother, like parents or siblings.
Right. So I would imagine the government has some kind of oversight on these things because they seem to have their finger in a lot of different pies to do with rules and regulations around money. The regulator for financial services, FinTrack, has a lot of rules for all of us that deal in financial trade and services, real estate, mortgage brokers. What about when people say are best friends or not related, but they want to purchase a property together, either to live in or as an investment? How do you work with non family related parties, and what kind of lending is available to that situation?
Yeah, so for example, we do see with especially expenses of the life right now, we do see some friends deciding to buy together and say both, let's say it's two parties unrelated, they just friends. Um, it's not a problem. We just evaluating them as co-borrowers, and so both of them getting evaluated based on their income and what they can afford. Definitely the next stage is going to be legality, and I usually refer that to the legal professional in order to get a full understanding how it's getting played out and how the registration needs to be done.
Right, because I would imagine unless the investment of each party was 50-50, you'd want to have an agreement in place of, you know, what each party's contribution was and if they went to sell, under what conditions, etc., etc.
Yeah, and some agreements can be only one side can sell it, so it's getting a little bit complicated. So that's why I always refer that to the legal professionals in order for the clients to get a full understanding up front. How is that gonna play out, and what are the risks and opportunity for them to buy it?
Right, right. One of the things that I have also found through the years is that um, often a first time buyer will buy their home and they'll be there, say, for 5 or 7 or so years. Maybe they'll renew their mortgage the first time after that first 5 year times, but then all of a sudden their life changes. They either get transferred, or more than likely, they have started a family and they need to make that next step up what we call the real estate ladder, the next rung on the ladder, the move up buyer. What are some of the pitfalls that you see some move up buyers falling into as far as affordability and or preparation? Obviously, I guess it'll have to do with the market and what their property's worth now. But are there any words of advice you'd have for people who are definitely wanting to have a trajectory of real estate? Because I think the days are pretty much over where people stay in their same home for 40 or 50 years. It doesn't really seem like that's the current reality. And life does change. You often do want either a bigger home or a smaller home. But for the move up buyers, what are things people should be doing in their first property to help them plan for the next stage in life?
Yeah, so first of all, for all the first time home buyers, I always saying, sometimes when they looking all over the place, I always saying your first home is not your last one. And statistically speaking, when the famous term for 5-year fixed term was in a few years back, usually statistically speaking, after 36 months, which is slightly over, after 36 months, usually when the change happening with many of the first time home buyers. And part of my process, what I'm doing, I'm calling a mortgage audit annually, or sometimes even twice a year. When it's big changes happening, I always reaching out to my database, and we're doing not only mortgage audit, we're doing once a year financial audit, just to prepare them. Even if, let's say, they're already in the property for 2 years, but they're expecting a second child or first child, so we already kind of getting ready, so that potentially within 1 year or year and a half, they already would have to move. So what that plan is going to look like, again, it all depends on their income. If they deciding to rent the current property, if they have enough equity in that property, they can pull the equity and buy that second property, or they would want to sell it and buy that second property. So in my process, annual mortgage audit or annual financial audit, that's how we planning ahead all the time. Because obvious the changes, some changes, they're not happening instantly, so that's why we have time to prepare. And unfortunately, sometimes the people deciding not to continue to live together, which is also happening not that often, but it does. Life is life, and definitely we have the decision to work with both parties if they're deciding, and giving them the very defined plan how to do it, or if one party deciding to stay in the property and buy out the second part of the equity, to buy
Mm-hmm.
out the spouse or ex-spouse. So definitely there is lots of plans we're putting together. And what I found for so many years doing that, it's so much greatly appreciated by the clients, those financials review annually.
Excellent. So, when you're explaining to people the different kinds of mortgage products that are available to them, one of the feedback that I've gotten from clients over the years is, and especially in the last 3 or 4 years, when so many people went into variable, not really understanding what the impact could be on them in the future. Um, do you find people just expect that all mortgages are the same, or what type of education do you do to people to help them to understand whether it's flexible, whether it's locked in? There's all these terms out there in the mortgage industry, and I find that a lot of times I'm even confused by what some of those terms actually mean. Can you explain the difference between a fixed and variable, and what type of, I kind of make a comparison to buying a car. Like, you can get the base model of the car and it's going to be less expensive, but maybe in the future you don't have as much appreciation, or the base model of the car only goes a certain amount of way on the highway before you need to refill the gas tank or something like that. What do you think really is, how do you help people decide what kind of mortgage is going to be best for them?
Yeah, so again, through our strategy call, I usually provide all the available options, even if it's a fixed, variable, if what type of institution have different types of variable or adjustable rates. What does it mean? Variable rate is truly a variable, and some of the adjustable rates, they adjusting based on a Bank of Canada adjustments, so the payments adjusting right away. With the variable rates, you basically depends on the institution we deciding to go. It can be static, so even if the prime rate, Bank of Canada rate goes up, you still can maintain your and be in control of your payments, which I'm not going to name the institution, but definitely those are not all of them, but some of the institution and most of my clients back in COVID time, they decided to go variable, but at least I gave them that option that they can be in control. So if the rate will go up, they will still maintain the same lower payment. Yes, it would be triggered interest trigger, but at the same time, they will be protected as far as the monthly payments concerned. And with the fixed rate as well, we do have other options. It could be 1, 2, 3, 4, and 5 years fixed. With the higher interest rate environment right now, we deciding to go on the either 1, 2, or 3 year fixed in order to mitigate that moving forward. Because myself, I don't believe that 5 year plus will maintain for longer than 3 years.
Right. So I think a lot of people have misconceptions about how mortgages actually work. And, a lot of people, there's some fear around having their commitment phobes, right? It's like, oh my God, a mortgage. It's like, this is adulting stuff, having to make payments and this and that. What are some of the things that you do to help people realize that it's not as daunting as they think it is? I think personally, it is my mission to try and help as many people, and especially young business women, get into their first home. That's always been a mission of mine. But I do find that sometimes, and especially women and younger women, think that your life has to be a certain way or has to look a certain way before you can own a home. And certainly affordability has a lot to do with it. But what are some of the mindset things that you try to put in place with your clients to get them over that fear of becoming indebted, to have that debt? A lot of people are very uncomfortable talking about money or thinking of being in debt, because a mortgage is a debt when you get right down to it. How do you change the mindset to more of an investment growth mindset than a fear-based debt mindset?
Yeah, so again, for luckily enough, I like numbers, and for me, the most important to provide that comfort zone for clients, especially through and as you know, I provide clients with my custom proposal or purchase budget, and during this time, once I have let's say we're talking about to purchase 500,000 property, first property, and the down payment will be very minimum, which is 5% only, which is $25,000. And let's say they're buying today for 500,000 and holding for 3 years. And all that information I provided on the Excel spreadsheet, definitely defining what is that property potentially will cost 3 years from now if they buy today. So within 6 or 7%, very conservative appreciation year over year, we see that property grows very nicely in price. And with the payments during these 3 years, and it's after 3 years, basically, it's very well shown that they can be having net worth of at least $150,000. And the way we calculate it is based on the annual appreciation of the property and the annual payments that is done already. So essentially, after 3-year term that they purchase a property, they have 150,000 net worth. Yes, it is equity in their home, but that will allow them to decide if they sell after 3 years. They have a down payment initially for 25,000 only, and after 3 years they have 150,000. So essentially, they have much easier resource to purchase that next property, to move up, or to define that 150,000 as someone actually paid them to have extra $50,000 in their bank account every year.
That sounds too good to be true. What's the catch?
Buy a property.
Bad property. Okay, well then that maybe goes back to the realtors and their job in educating someone as to how to pick a good property, which is also one of my favorite things to do, is go out on tour with clients and point out all the bells and whistles and warts and things that happened in the aging of a building. And even some new builds aren't really that great, but that's why having a great mortgage professional is one of the most important things to me as a realtor, because I want to stay in my lane and do what I'm good at. And oh my God, spreadsheets are definitely not it. I think the first time when I saw one of your spreadsheets, I actually felt a bit overwhelmed and intimidated because it was so organized. I was like, oh my God, what am I getting myself into here? This woman's like a machine. Your background in IT, do you find that's really helped you be a good analytical person when it comes to finance?
Yeah, so yes, I finished computer science degree, but worked only 1 month into it because I understood very quickly this is more to be an engineer. It's more like working with myself, and I am more of the talking person, and that's how I found myself working in operation environments as a supply chain manager. So again, lots of numbers and whatnot. And then about 9 years ago, I decided to become a mortgage broker because very fit to my personality, and I love talk to people and especially educate them a little bit about numbers and budgets. That's kind of my main thing, and that's what even all my Google reviews they saying about my financial ideas with that custom proposals or mortgage purchase budget that not many people actually provide them, especially when they go into the bank. They just giving them numbers without really giving them the full 360 degrees overview.
Definitely. Well, Rima, I've really enjoyed our talk today. I hope people have learned a little bit about the fact that it is possible with planning to buy a property. I know some of my first-time buyers, or even some of people that I meet in open houses, they think that their first property has to be all shiny and special, like something on TV. Just to end our conversation today, what if somebody wants to refinance their property to do some improvements, or if somebody's buying a property that's their first property that's going to need some sweat equity? Do you have solutions for that?
Yes, especially when we call it purchase plus improvement. So, for example, if clients have seen a property, but everything works perfectly except that kitchen or the bathroom, we actually have programs at the same time. We call it purchase plus improvement, that we can that mortgage is going to be approved with that improved kitchen or bathroom, and maximum is $40,000 for that improvement to happen. Very important also to understand that $40,000 coming only after the work is done. So definitely also preparation up front, are understanding the whole process, what are the requirements. No problem at all to do it. If we do a refinance, again, it's that's what a lot of people right now actually have equity in their properties, but not enough. But also at the same time they have a vehicle to that's really choking them with the monthly payment. So at the time of the refinance, we also can put that car loan into the mortgage to easy those payments for the client. So lots of options for the clients, and definitely very excited. Just last month, I helped the clients with the refinance to save them $2,000 a month for the payments. So it's always makes me feel so good.
So it's not just about mortgages, it's having a total plan in place for managing your cash flow, maximizing your long term options, and helping to build equity in your home. I love it.
100%,
That's
100%, yes.
That's great, Rima. We'll definitely have you on again as a guest, and I really thank you for being on our first guest of the programming, and we'll probably have you on again next month. So have a
Fantastic.
great month, and we'll talk to you soon.
Thank you so much for the opportunity again, Shelly, and looking forward to chat with you.
You bet. Take care, Rima.
Cheers. Bye bye.
Bye.